So, like I said before, we were reviewing today and Wednesday. So, instead of just going over and re-lecturing about the stuff, I think it'll probably be more useful to just work through some of the comprehensive problems from the chapters, and I selected a few out today that should give a good representation of the stuff we covered during the first half of the semester. It doesn't mean that you only have to know exactly what's in the review today and Wednesday. It also doesn't mean that this is the format the final is going to be. I kind of changed my mind from the beginning of the semester how I want to do the final. So the final is going to be more of, rather than testing you on doing all the journal entries and stuff, it's going to be multiple choice and true false like some of the quizzes have been. What's that? You're good with that? I figured. So that's just because I figure as intro to accounting students, it's more important that you just have a general idea of what's going on rather than me expecting you to be able to do it as an accountant would. It will be, if I didn't mention this before, it will be open book, open note, all that stuff. The exam will start on Friday. We'll do half of it Friday. So it'll basically be function kind of like two exams, part one, part two. So you have to do part one on Friday, and when you finish part one, you just leave. You can't do them both on Friday. And then Monday will be part two, okay? So going all the way back, and I will post a recording of this as well, so if you want to look back over this to study, that's fine. I'll post it today probably. But going back to the beginning of the semester, remember the first thing that we talked about was the basic accounting equation. So for this question, it's basically asking us to look at these individual transactions and write how they would affect the basic accounting equation. And if you remember basic accounting equation, assets equal liabilities plus, owner's equity. Okay, so each one of these transactions will affect the equation in a way that it will still be true and equal that when we're done with each transaction. So, A. Smith, let me read the, let me blow this up a little bit. Okay, so Ron Smith opens an apartment locator business near a college campus. The company will be named Campus Apartment Locators. During the first month of operations, which is July, business completes these transactions. So, A, Smith contributes $35,000 to the business. The business gives capital to Smith. So the way that this question is worded, it kind of helps you to understand what's going on. So from the perspective of the business, first thing that happens, the business receives assets, $35,000. So, assets, whoops. Okay, it's not one to let me do that. Let me just write it in. Assets go up $35,000. Owner's equity goes up $35,000. Okay, so that's part A. From a contribution of capital from one of the owners. Part B, purchases $350 of office supplies on account. So you have office supplies are an asset, so your assets go up $350, and liabilities also go up $350 because we've now incurred that much debt that we'll have to pay off in the near future. So still a balanced equation. Part C, pays cash of $30,000 to acquire a lot next to campus. So this is one of those items that affect the equation on only one side of the equation, but it will still equal out. So we have cash going down $30,000, but we also have an asset going up $30,000 because the lot or the land that we're purchasing is an asset. So on this one, it goes down on the asset side and up on the asset side during the same transaction. D, locates apartments for clients and receives cash of $1,900. This is what we're in the business of doing, locating apartments for clients. They pay us for that service. So this is service revenue. So let's see here. That's $1,900 cash that we received. Whoops. Up $1,900. And the way that revenue affects owner's equity is it causes owner's equity to increase. Okay, so $1,900 in cash and $1,900 in revenue that causes owner's equity to go up as well. Pays $100 on the accounts payable the business created in transaction B. So this right here needs to go down by $100 to pay off part of that liability, and we did that with cash, so that goes down by $100 as well. F pays cash expenses for office rent, $400, and utilities, $100. Okay, so these are expenses, and we're paying them in cash. So paying anything in cash obviously causes cash to go down. It will go down by $500. And expenses, the way that those affect the owner's equity is it causes owner's equity to go down by whatever amount you pay in expenses. Okay, so far so good. They all match up. Equation still equals the same balance that it was before. Final portion, Smith withdrew cash of $1,200. Okay, so again, Smith is one of the owners or the owner, and he is causing the business to lose or to have less cash by $1,200. Okay, so since he withdrew that, his equity, or her equity, I guess it's Ron, so his, goes down by $1,200 as well. Okay, so we got a pretty decent example of most types of transactions. You see one where it happens both on the asset side, and generally that's the main place where you will see two transactions occurring on the same side as on the asset side when you're just changing cash for some other type of asset. Okay, so then it says, and the next part says prepare the income statement, statement of owner's equity, and balance sheet of the business after recording the transactions. I'm actually going to skip that part just because with this much information, first of all, they're going to be really simple statements. But basically, I would say that you should know, and one of the other problems we'll do it a little bit more thoroughly. But when you're asked to prepare an income statement, the first thing that should come to your mind is let me just locate anything that's a revenue and anything that's an expense. So in this example, no revenue or expense here. Part B, no revenue, no expense. Part C, no revenue, no expense. And the reason that this is not revenue or expense is because if you did a journal entry for that one, there would be no account labeled expense in that entry because it would be a capital asset that you would depreciate. Part D is the first part where we have any revenue or expense. This is revenue of $1,900. And then, let's see, Part F is where we get into our expenses, and that would be $500. So with these examples, the only revenue we have is D, and the only expenses we have is F. So if you were doing an income statement, you would have revenues $1,900, expenses $500, and your net income would be $1,400. Okay. For the statement of owner's equity, you just basically would look at all of these transactions and say, okay, which of these transactions affected owner's equity? So for each of these that affected owner's equity, you would have those recorded in the statement of owner's equity. So basically, for A, we would start with 0 in the statement of owner's equity because this is a brand new business. Owner contributes $35,000, so that's plus $35,000. Then you have revenue and expenses, and that comes into the owner's equity statement through net income. So you would say then add to that number net income of $1,400, and then subtract from that number the amount that the owner withdrew, $1,200. Okay, so that's what the statement of owner's equity would look like. And then the balance sheet would just be assets and liabilities, recording the assets that we purchased, and then also recording our remaining liability, which would just be that one account payable. So they would be pretty simple on that one. And like I said, we'll look at doing a slightly more complicated one as we move on here a little bit. So that was from, I believe, Chapter 1. Okay, so the next one, we have this trial balance right here. And then we have a bunch of transactions. It says during March, the business engaged in the following transactions. And we have all those all listed here. And then what we're asked to do is open the accounts listed in the trial balance using the balances indicated and open those in a T account format. If you remember, we had a couple quizzes and some example problems that we worked like this during the semester. So there's several steps here. First, we're going to put them in T-charts. Then we're going to look at each one of these transactions and do a journal entry for each one of those. Then we're going to take the effects of the journal entries and transfer those over to the T-charts. And then we would basically look at all the balances in the T-chart and transfer those numbers back into the trial balance. Okay, so we are going, it's going to take a couple minutes here just to label all these and get them squared away, but we're just going to go one by one through all of the accounts in the trial balance here, and we're going to make sure that we pay attention to the debit side versus the credit side, and whatever the balance is there, that's the balance that we're going to put into the T-chart. So cash was $26,000. Let's see. Let me just make some more T-charts. Accounts receivable $4,500. Office supplies and land are both 0, but we're going to put it in there anyway. Then we had, those were our assets basically, and then we have some liabilities. We got accounts payable for $2,000. And that was a credit, so we want to make sure that goes in on the right side. Then these all are 0 balances, but we're still going to put those 0 balances on the right side just to remind us that these carry credit balances. So we got utilities payable, unearned revenue, and notes payable all 0. Let's see, and we had Harper Capital with a $28,500 credit balance. And Harper withdrawals with a 0 balance. And that carries a debit balance, so I'll put the 0 there. Then we have these temporary accounts with withdrawals being one of them, but the revenue and expenses, so all the ones that are going to go into the income statement, which we'll fill in when we go through the journal entries. But we've got all with 0 balances right now, but that's going to change. So I think we had service revenue. Credit balance, but 0 right now. Salaries expense, debit balance, but 0 right now. Rent, interest, and utilities expense. And each of those with a 0 balance. Okay, so all I've done is with T-charts, I've opened all of these accounts here and listed based on the trial balance what the account balance is for each of those. Okay, so that was requirement 1. Now I will go through and journalize all of these journal entries. Okay, so got the date, March 2nd. Borrowed $45,000 from the bank and signed a note payable in the name of the business. Okay. Oops. No. Borrowed $45,000 from the bank, so we are getting $45,000 cash. And the credit is going to be notes payable for $45,000. And then my comment here or my description will just be borrowed money from bank. Okay, March 4th. Paid cash of $40,000 to acquire land. So this is one of those that we're trading one asset for another. So we've got land, asset going up, cash, asset going down. Description, bought land. March 9th. Performed services for a customer and received cash of $5,000. We know what we received, cash. We know the amount, $5,000. This is service revenue, $5,000. Performed services for clients. Okay, March 13th. Purchased office supplies on account for $300. So we're going to debit office supplies for $300, and we will credit accounts payable for $300. Bought supplies on account. 15th March. Performed services for a customer on account. So again, they owe us money for services that we've already performed. So instead of receiving cash, we just have this accounts receivable, but it's still considered service revenue. performed services for client, and I would probably just add on account there. Okay, 18th of March. Paid $1,200 on account. Oops. So we are basically paying off a debt here, so $1,200 goes to our accounts payable. Cash goes down by $1,200. Paid money on account. So obviously I'm trying to move through these kind of quickly just so we can cover all the material. If you have a question, you need me to stop, please raise your hand or shout out or whatever. But I just want to make sure we cover everything. So March 21st, paid the following cash expenses. Salaries $3,000, rent $1,500, and interest $400. So first thing I need to do, well, I guess it doesn't have to be the first thing. But eventually I have to total all these up. Okay, so each expense account is going to be debited here. So we have salaries expense debited for $3,000, rent expense debited for $1,500, and interest expense debited for $400. Then I need to add all those up. So $3,000 plus $1,500 plus $400 gives me $4,900, and that's going to be a credit to cash. Then I have the 25th of March. I guess I should put a description in there. Paid expenses with cash. Okay, 25th. Received $3,100 from customer on account. So I received cash. The amount is $3,100. What goes down when I receive cash for something that they owe me is accounts receivable, which I'll just abbreviate. So that now shows that they don't owe me that $3,100 anymore. Received, owed money on account. 27th of March. Received a $200 utility bill that will not be paid until next month. So this is one of those adjusting entries that we talked about before, and I just need to record the fact that I owe this money. Oops. So as soon as I owe the money, basically I'll recognize the expense. So I have utility expense is the debit there for $200, and the credit will be to accounts payable for $200. $29th of March. Received $1,500 for services to be performed next month. Oops. So what did I receive? I received cash for $1,500, and that is not earned money, so it's basically a liability until I actually do the service. So I have unearned revenue of $1,500. Description, received advance payments for $1,500. Finally, 30th of March, got an owner withdrawal here. Oops. We got a debit to Harper withdrawals. For $1,800, and the credit will be to cash for 1800. Okay, so that's all of our journal entries. Okay, so then next step, post the journal entries to the ledger using the T account format. So basically, look at all your journal entries and see how they affect the accounts that we opened over here. Okay, so we'll start with the first one. Debit 45,000 cash, credit notes payable 45,000. So where's my cash? Right there. Debit 45,000. Find my notes payable. Credit 45,000. Okay, and then, whoops, too far. What I'll do here is highlight that just to show that I've already done that one. So next, debit land 40,000, credit cash 40,000. So debit land 40,000, credit cash 40,000. Okay, next, debit cash 5,000, credit service revenue 5,000. Oops. This 40,000 here was supposed to be a credit. Debit cash 5,000, credit service revenue 5,000. There it is. Oops. Debit office supplies 300, credit accounts payable 300. Debit accounts receivable 2,600, credit service revenue 2,600. Debit accounts payable 1,200, credit cash 1,200. I know this can get monotonous and tiresome, but you really just got to focus to make sure you're putting the stuff in the right debit or credit column. So obviously it's not that difficult to look at what you wrote here and transfer that to a T-chart, but with the simple stuff like that, that's when you tend to make the most easy mistakes just because you're not paying as much attention. So then on the expenses, we've got a credit to cash of 4,900. We've got a debit to salaries expense for 3,000. Debit to rent expense for 1,500 and 400 to interest expense. We got a debit to cash for 3,100, a credit to accounts receivable 3,100. Debit to utility expense 200, credit to accounts payable 200. Debit to cash 1,500, credit to unearned revenue, $1,500. And finally, debit to Harper withdrawals, $1,800, credit to cash, $1,800. Okay, so all I've done, again, is one by one, gone through each one of these journal entries. Where I saw debit, I found the account, and I plugged that into the debit side of the account. Same thing for credit. Then you would go through, to do part 4 here, you would go through and total up each of these accounts. Okay, so I would add up all the debit side, add up all the credit side. If the debit side's more, then I subtract the credit side, and I get my balance there. Okay, so let's see here. I don't have a lot of room in the cash account, but clean it up a little bit here. So I'm adding up everything on the debit side, and then I'm adding up everything on the credit side. And then here I'm just subtracting from the credits from the debits. My balance is $32,700. Okay, so just to clean it up a little bit, I'm going to erase all of the individual transactions and just leave my balance in that one, just because that one's kind of jumbled. Okay, the rest of them are pretty easy because there's not that many transactions in them. So I've got 4,500 plus 2,600. That's 7,100 minus 3,100. So the balance there is 4,000. Office supplies, obviously, balance stays. Anything with just one number in it just stays whatever that number is. Accounts payable, 2,000 plus 300 plus 200 is 2,500 minus 1,200 is 1,300. Unearned revenue, all of that stays the same. Service revenue, just add those two together. And once you got the balance for each one of those, you would just take that balance and go back in with a blank one of these and put the new balances into all of these accounts. At the end of the day, the debits and the credits will still equal each other, though they will not necessarily equal this number. They will definitely equal each other. Okay, so then you will have an adjusted trial balance. Okay, so finally, we have this last question here. King Cornelius Company uses a perpetual inventory system. The adjusted trial balance of King Cornelius Company follows. So since this is the adjusted trial balance, they basically just got done doing what we just did. Okay, they plugged all the numbers back in after doing all those T-charts, and this is the trial balance that they're left with. So then we have over here, journalize the closing entries of December 31st, post to the income summary account as an accuracy check on net income. Recall that the credit balance closed out of income summary should equal net income as computed on the income statement. Also post to Cornelius Capital, whose balance sheet should agree with the amount reported on the balance sheet. So basically what we're going to do here, looking at the adjusted trial balance, we're going to look at all these accounts down here that we consider temporary accounts, and we're going to close those temporary accounts out. Okay. Once we do that, that will allow us to calculate excuse me, net income. So, closing entries, what do they look like? We'll do the revenue side first. So we've got sales revenue, and that's the only revenue account that we have, of $244,000. I'm sorry, we also have interest revenue here. Okay. So we're going to want to close both of those out. They're credits right now, so we need to make them debits. So we have a debit to sales revenue and a debit to interest revenue. Okay? And the credit side is going to be to the income summary account. So sales revenue, we just look over at the adjusted trial balance. That's $244,000. Interest revenue, right there, $2,000. Add those two together, and the amount that goes to income summary, $246,000. Okay. So for the debits or for the expense side, the debit will be the income summary, and the credit will be all of the expense accounts. And then also, since this is a merchandiser, we also include in those expense accounts the contra revenue accounts, and those are these two accounts here that kind of function like expense accounts because they serve to lower sales revenue. Okay. So we have sales returns and allowances and sales discounts. Then we have all of the accounts that are actually labeled as expenses, salaries expense, rent expense, utilities expense, depreciation expense, supplies expense, and interest expense. Okay, so we're going to go in and fill in all of these various expenses, and that will be our credit side, and then we'll just add all those up, and that will be what goes on the debit side for the income summary. So sales returns and allowances was $10,000, discounts was $8,000, salaries expense was $72,700, rent expense $7,700. Whoops. Depreciation or utilities expense $5,800. Depreciation expense $2,700. Supplies expense $2,200. And finally, interest expense $2,900. Like I said, all we're going to do is add up all of those expenses. And that amount goes in the income summary side. Okay, so what did it ask us to do here? So if we're calculating net income based on what we have here, revenue minus expenses, we'd say net income equals revenue minus expenses, or $134,000. So we're going to take that, a number right there, and we're going to check it against when we do the income statement to make sure that we got the right number, because the income statement totals to net income at the bottom. Okay, so when we get to the total here, that should equal the net income that we calculated using this closing entry and looking at what was inside the income summary account. Okay, so to do that, we want to start filling out this income statement. But I think it asked us also to close, let's see here. I'll just wait on that one. Okay, so sales revenue, already looked at that. That was given to us here, $244,000. So I plug that in there. And then, whoops. We're going to subtract sales discounts and sales returns and allowances. So we have 10,000 and 8,000. And when we add those those three together, or when we basically subtract discounts and sales returns and allowances, that gives us our net sales revenue of $226,000. Oh, but I left out cost of goods sold. Whoops. So cost of goods sold should also have been added as one of these expenses here. I just skipped over it. There it is, 81,000 cost of goods sold. So let me that's going to change my number there. Okay, so now my net income is $53,000 when I add in cost of goods sold there. And then going back down to my income statement, next step in the income statement is cost of goods sold, which is $81,000. And when we total net sales revenue with cost of goods sold, that gives us our gross profit. Okay, so gross profit now is $145,000. Then we're going to go in and add in all of these expenses. So we had salaries expense, which was $72,700. We had rent expense, which was $7,700. We had utilities expense, which was $5,800. We had depreciation expense, which was $2,700. We had supplies expense, which was $2,200. We had, let's see. So then we total those up because interest expense goes down here in the other revenue and expense category. So after supplies expense, we total all these up to get all of our operating expenses. So we have operating expenses of $91,100. So then we take our gross profit here, subtract our operating expenses here, and that gives us our operating income. So these are broken down into various steps here. This is called a multi-step income statement because there are various ratios, like the things that we talked about at the end of each chapter, that investors look at to evaluate a company. Some of those will use gross profit, so it's helpful to have a statement that shows what that is. Some of those will look at and use operating income, so you got to have a financial statement that shows that. And then some of them will look at net income, which we will look at as well. So from operating income, we now are going to add and subtract other revenues and expenses. And these are basically items that are not considered part of our day-to-day business operations. Okay? So we're going to add in interest revenue, which was $2,000. We're going to subtract interest expense, which was $2,900. So our net effect there, the total other revenue and expenses, is negative $900. Okay, so we take operating income and we subtract $900, and that will give us our net income of $53,000. And if we look up here at the number we calculated just using the income summary account, it is also $53,000. So that's how we check to make sure that we've done it correctly. And while this doesn't guarantee that we've done it correctly, it at least shows us that we didn't leave anything out in between doing the closing entries and filling out our multi-step income statement. Okay, then we have our statement of owner's equity, which basically is going to take what we have on this trial balance, which was the beginning balance of owner's equity. That's $22,200. and we're going to adjust it based on anything that happened during the year. Was there any owner's contributions during the year? Well, let me look at the trial balance. Let's see. I don't see any owner's contributions during the year. So I'll put a 0 there. Okay, net income for the year we get from the income statement, $53,000. So I'm going to add $53,000. Were there any owner's withdrawals during the year? Yeah, I saw one of those. Okay, right there. Cornelius withdrawals, $48,000. Okay, so I'm going to subtract out $48,000 here. And I will add these up, subtract this. And my new balance in the capital account after I've done all of these is $27,200. Okay, so that's what the statement of owner's equity shows. Anything, and if we had done the same basic accounting equation with all of these entries, these would be all of the entries that had anything that touched the owner's equity section. So whatever touched the owner's equity section gets reflected there. Okay. And then I think the last step was to prepare a balance sheet, but basically the balance sheet doesn't really change here. So the adjusted trial balance is here. The only thing that changes on the balance sheet is the owner's capital goes from this number to this number. So if you had to do a balance sheet with this information, basically you would take out all of the temporary accounts, which is from this line down. So we take all of that out and leave everything above that the same except for owner's capital, which changed based on our statement of owner's equity, and this would be the new number there. Okay? That's it for today. Like I said, this recording will go up. Take a look at that. We'll move into the second half of the review on Wednesday. Make sure you sign the sheet if you came today.